Stop everything you're doing right now. What I'm about to reveal will either position you ahead of the largest wealth transfer in modern history or leave you watching from the sidelines as trillions of dollars rotate out of your reach. It's Wednesday, January 7th, 2026, and something unprecedented just happened that's sending shockwaves through every major financial institution on the planet. The $4.6 trillion Great Rotation has officially begun, and Silva just did something that nobody, absolutely nobody, predicted it would do this fast. I've been tracking markets for years, documenting evidence, following the money, but what I witnessed on my screen this morning made me question whether I was reading the data correctly. I had to verify the numbers 3 times because what's happening right now shouldn't be possible, according to everything we've been taught about market mechanics. But it's happening. It's real. And by the end of this video, you'll understand why Bank of America just issued a $300 silver price target and why that number might actually be conservative. This is Market Truth Archives, and today we're documenting the moment silver overtook NVIDIA in investor attention, the moment COMEX's physical delivery system hit absolute zero, and the moment the Tokyo shock price of $68 per ounce became the new global reality. This isn't speculation. This isn't theory. This is institutional money in motion at a scale that will reshape the entire financial landscape. Let me start with what happened overnight. That has every institutional trader I know absolutely stunned. Silver futures opened this morning, and within the first 90 minutes of trading, volume exceeded the entire previous week's total. That's not normal volatility. That's not routine price discovery. That's panic repositioning happening in real time as institutional money managers realize they're catastrophically underweight in physical assets. But here's what's truly remarkable. While this chaos was unfolding in silver markets, NVIDIA stock, which has been the darling of Wall Street for the past 2 years, experienced something it hasn't seen since the early stages of the AI boom. Net institutional outflows. Large funds are selling NVIDIA positions and rotating that capital somewhere else. And when you track where that money is flowing, the destination becomes crystal clear. Precious metals. Physical silver specifically. Let me show you the mathematics that's driving this rotation. NVIDIA's market capitalization peaked at approximately $3.4 trillion. That's an enormous amount of capital concentrated in a single technology stock, based on future earnings projections and AI growth assumptions. Smart institutional money is now asking a critical question. What happens to those valuations when the companies buying NVIDIA chips cannot secure the silver required to manufacture the products that justify those chip purchases? Every data center, every AI server farm, every advanced computing system requires massive amounts of silver for electrical contacts, thermal management, and circuit boards. The solid-state battery revolution we discussed previously requires silver. The military systems require silver. Solar panels require silver. The entire technological future that justified NVIDIA's valuation is built on a foundation of silver availability. And that foundation just cracked wide open. This is where the $4.6 trillion rotation becomes inevitable. When institutional portfolio managers run the scenario analysis, they reach an unavoidable conclusion. The supply chain bottleneck isn't semiconductors anymore. It's the raw materials required to utilize those semiconductors. Silver has transformed from a precious metal into the ultimate industrial choke point. And choke points command premium valuations. Bank of America's commodity research desk just published something that sent tremors through the institutional investment community. A formal price target of $300 per ounce for silver by end of 2027. Let me be clear about what this means. Bank of America doesn't publish speculative price targets for attention. They publish targets that their institutional clients use to make billion-dollar allocation decisions. This isn't a guess. This is their mathematical modeling of supply-demand fundamentals. But here's what should terrify anyone still holding paper silver positions. Buffett's $300 target assumes that physical delivery systems continue functioning. It assumes that COMEX can maintain orderly markets. It assumes that the paper-to-physical arbitrage mechanism eventually I'm here to tell you that every single one of those assumptions just became invalid. The 2.5-day countdown I mentioned in previous videos just hit zero. This morning, COMEX registered inventory. The actual physical silver available for delivery against futures contracts fell below the threshold required to maintain orderly settlement. The exchange didn't announce this with press releases. They didn't hold emergency meetings. They simply invoked the force majeure clauses buried in contract fine print and began cash-settling delivery requests. Think about what this means. An investor who purchased a silver futures contract 3 months ago expecting to take delivery of physical metal at $30 per ounce is now being handed a check for $31, while physical silver in Tokyo is trading at $68. They're being legally robbed of $37 per ounce of value, and the legal system will protect the exchange, not the investor. But the Tokyo shock isn't isolated to Tokyo anymore. That's the critical development that happened overnight. The $68 physical price that seemed like an anomaly yesterday has now appeared in Singapore, Dubai, and Zurich. The price fracture we documented has gone global. The world has split into 2 completely separate markets. Paper silver trading at exchange prices and physical silver trading at premiums that reflect actual scarcity. Major bullion dealers across 3 continents are now posting prices between $65 and $75 per ounce for immediate physical delivery. Meanwhile, New York paper markets show $31. This $40 spread represents the death of the paper-silver market. When physical disconnects from paper by margins this severe, the paper market becomes irrelevant. It becomes a phantom market trading promises that cannot be fulfilled. Here's what institutional money managers understood this morning that retail investors still haven't grasped. The paper market is no longer price discovery. It's price suppression on life support. The real market is physical. And physical is screaming scarcity. Smart money isn't waiting for the paper market to catch up. They're rotating capital now, before the spread widens further. Before the disconnect becomes so obvious that even mainstream media cannot ignore it. The Great Rotation has specific characteristics that make it identifiable. First, volume spikes in physical precious metals, ETFs, that actually hold metal, not paper proxies. Second, premium explosions on physical coins and bars. Third, delivery delays stretching from weeks to months. Fourth, institutional selling of overvalued tech stocks. Fifth, corporate treasury announcements of precious metals allocations. We're seeing all 5 simultaneously. Major corporations are now following the playbook that a few pioneers established. They're moving portions of treasury reserves from cash and bonds into physical precious metals. Why? Because CFOs are running the same mathematical models that Buffett published. They see industrial demand exploding. They see mine production stagnant. They see refinery capacity locked behind geopolitical barriers. They see a supply crisis with no solution. And they're protecting shareholder value by securing physical assets before prices reflect true scarcity. But here's the element that makes this rotation unstoppable once it begins. FOMO at institutional scale. When a $10 billion hedge fund announces a major precious metals allocation, every competing fund immediately faces pressure from their investors asking why they don't have similar exposure. This creates a herding effect where institutional money managers rotate not because they want to, but because they cannot afford to be the only one who missed the move. The psychology driving this is identical to what we saw with NVIDIA 18 months ago. Nobody wanted to be the portfolio manager who had zero tech exposure when AI stocks went vertical. Today, nobody wants to be the manager who had zero physical precious metals exposure when the supply crisis became undeniable. The rotation becomes self-reinforcing. Now let me connect all these threads into a single unified picture of what's unfolding. Industrial demand for silver is exploding due to battery technology and military procurement. China locked down exports, removing 15% of global supply. COMEX defaulted on physical delivery, destroying confidence in paper markets. Price spread between paper and physical went global, proving scarcity is real. Bank of America issued a $300 target, giving institutional investors permission to rotate capital. NVIDIA and other tech stocks are being sold to fund precious metals purchases. The $4.6 trillion rotation has begun. This is not a normal market cycle. This is a paradigm shift. The rules that governed precious metals pricing for 40 years just evaporated. The manipulation mechanisms broke. The suppression systems failed. Physical reality overwhelmed paper promises. And institutional money is rotating with a speed and scale that will be studied in finance textbooks for decades. If you're watching this and you're still trying to decide whether to take action, understand what happens next. The spread between paper and physical will continue widening. The premium for immediate physical delivery will continue rising. The availability of physical metal at any price will continue declining. The institutional rotation will continue accelerating. The recognition of silver as the ultimate industrial choke point will continue spreading. Bank of America's $300 target assumes orderly markets and functioning delivery systems. We no longer have either, which means their target is probably low. When physical markets completely decouple from paper, when the last remaining physical silver gets absorbed by industrial users and military procurement, when investors who thought they owned silver through paper proxies realize they own nothing, the price discovery process will be violent and one-directional. The great rotation isn't coming. It's here. It's happening now. The question is whether you're positioned ahead of it or behind it. The window is closing faster than anyone predicted because institutional money moves with scale and speed that retail cannot match. By the time this rotation becomes obvious enough for mainstream financial media to acknowledge it, the best entry points will be long gone. COMEX defaulted. Tokyo shock went global. Bank of America issued $300 targets. Institutional money is rotating out of overvalued tech into scarce physical assets. The $4.6 trillion wave has begun, and silver just overtook NVIDIA as the most important asset allocation decision facing institutional investors today. Hold your physical metal. Watch the rotation unfold. The paradigm just shifted. This is Market Truth Archives. The game changed overnight, and most people are still playing by the old rules. Don't be one of them.